Most people think their biggest financial risk is the stock market crashing or losing a job suddenly. It is not. The biggest risk is something quieter, slower, and far more devastating than that. It is the moment your body or mind stops cooperating with the income you depend on every month. That is the risk almost no one prepares for, and it changes everything once you finally see it. You build a budget, you save, you invest, and to assume your paycheck will keep arriving on time. But your entire financial life is sitting on one fragile assumption nobody really wants to talk about. The assumption is that you will stay healthy enough to keep earning the income that funds your life. The day you finally protect that income with disability insurance, something deeper begins to shift inside you. You stop making decisions from quiet fear, and you start making decisions from steady, grounded clarity. This is not about insurance products or premiums or fine print or any boring corporate language at all. This is about what happens to your decisions, your stress, and your future when income risk is handled. I want to walk you through what really changes, because most people never hear this part out loud. Let us start with the truth that almost every American adult quietly carries but rarely says out loud. You are one diagnosis, one accident, or one chronic condition away from your entire plan falling apart. Not because you are weak, not because you are careless, but because income loss is brutally common. Roughly 1 in 4 working adults will face a disability that interrupts their income before retirement age. That number is not dramatic, it is statistical, and it quietly contradicts how most people plan their lives. Most plans assume 40 straight years of earning, saving, and compounding without a serious health interruption. That assumption is not a plan, it is a hope, and hope is not a financial strategy you can rely on. When you finally understand that, your relationship with money begins to mature in a very specific way. You stop chasing flashy returns and start protecting the engine that actually creates every dollar you have. That engine is your ability to earn. Not your portfolio, not your house, not your side hustle. Your earning power is the single most valuable financial asset you will ever own in your entire life. A 30-year-old earning $70,000 a year will likely earn millions before retirement begins. That future stream of income is worth more than any investment account most people will ever build. And yet most people insure their car, their phone, their pet, but not the income that funds everything. That is the quiet imbalance disability insurance corrects, and it is why everything shifts once it is in place. Now let us talk about what actually changes emotionally, because the financial part is only half the story. Before disability coverage, most people carry a low background hum of financial anxiety they cannot quite name. They do not know it is there until it is gone, the same way you do not notice noise until silence arrives. You overspend a little because life feels uncertain, and saving for a distant future feels almost pointless. You underinvest because part of you wonders if you will even be healthy enough to enjoy that future. You delay big decisions because deep down you know your plan has no protection against the worst scenarios. That hum quietly drives 1,000 small choices that you would never connect to your missing safety net. Once disability insurance is in place, that hum begins to fade, and your decisions get noticeably calmer. You stop reacting to short-term fear, and you start choosing from a place of long-term financial confidence. That is the real product of disability insurance, not the policy, the clarity that the policy quietly creates. Let me give you a real-world example that probably sounds familiar to a lot of working professionals out there. Imagine a 35-year-old software engineer earning $150,000 a year in Texas. She has a 401k, a Roth IRA, an emergency fund, and a reasonable mortgage payment. She believes she is doing everything right, and on paper, she absolutely is doing many things very well. But she has no disability insurance because her employer offers only a small short-term policy she barely reviewed. Then she develops a chronic autoimmune condition that limits her ability to work full-time for almost 2 years. Her emergency fund disappears in 5 months. Her credit card balance grows. Her retirement contributions stop completely. She withdraws from her 401k early, paying taxes and penalties just to keep her household running. Her financial plan does not just slow down, it reverses. Years of progress vanish in a handful of months. Now imagine the same scenario, except she had a long-term disability policy replacing 60% of her income. The chronic condition is still painful, still stressful, still life-altering, and still emotionally heavy in many real ways. But her mortgage gets paid, her retirement accounts stay invested, her emergency fund stays mostly intact and protected. She recovers as a person without becoming financially broken as a household. That is the entire point right there. Disability insurance does not prevent the storm. It prevents the storm from destroying everything you have already built. This is where the deeper psychological shift begins, and it is the part most financial channels never explain clearly. When you know your income is protected, your nervous system stops treating every financial decision like a survival threat. You stop confusing safety with stagnation, and you start seeing investing as a long game instead of a gamble. You stop confusing fear with caution, and you start recognizing which risks are actually worth taking on purpose. Healthy caution protects you. Fear-based caution quietly keeps you stuck in jobs, houses, and habits you have outgrown. Disability insurance shifts you from fear-based caution into deliberate, intentional, grounded caution that actually serves your goals. That single shift changes how you negotiate salary, how you invest, and how you think about career risk. You become willing to take the job with better long-term equity instead of clinging to the safer paycheck. You become willing to invest more aggressively in index funds because your downside is no longer catastrophic loss. You become willing to start the side business, the certification, the move, the change you have been postponing. Because the worst-case scenario is no longer the financial cliff you secretly feared every single time you considered it. Now let me address something a lot of people quietly believe, even if they would never say it out loud. Many people assume their employer disability coverage is enough, and that assumption is one of the most expensive ones around. Most group long-term disability policies replace only 40 to 60% of base salary, often capped quite low. Bonuses, commissions, and equity are usually not covered, which matters enormously for higher earners and sales professionals. The benefits are typically taxable when the employer pays the premium, which shrinks your real take-home replacement amount further. The policy disappears the moment you leave that job, which means your protection is tied to your employer. That is not real protection. That is borrowed protection that can vanish exactly when you need it the most. A private long-term disability policy follows you, pays tax-free benefits when you fund the premiums yourself, and stays consistent. This is one of those moments where the math quietly contradicts the story most workers tell themselves about coverage. You are not as protected as you think. You are protected in a way that depends on your employer staying. That is a fragile structure for the most important asset in your entire financial life, which is your earning power. Now let us talk about who actually needs this most, because not every situation calls for the same approach. If you have no dependents, no debt, and significant liquid savings, your need is real but smaller and more specific. If you are the primary earner in a household, have a mortgage, have children, or carry debt, your need is enormous. If you are self-employed or a one-person business, you have no employer safety net at all, which raises the stakes. If your income depends heavily on physical ability or specialized cognitive skills, the risk concentration is even higher than average. A surgeon, a dentist, a pilot, a software architect, a freelance designer all carry concentrated income risk in their bodies. For these earners, disability insurance is not optional protection. It is the foundation that every other financial decision sits on. And yet most professionals delay this decision because it feels uncomfortable, complicated, expensive, or simply easy to keep postponing. That delay is one of the most common and most expensive psychological traps in personal finance, and it costs people dearly. The longer you wait, the older you get, the more health conditions appear, and the more expensive coverage becomes overall. Some conditions become uninsurable entirely, which means the door quietly closes while you are still telling yourself you had time. This is a classic case where the best financial decision is psychological first and mathematical second, and not the other way. You are not just buying a policy, you are buying the ability to make every other decision from a calmer place. Now let me share a few exact phrases that help when you start thinking through this kind of decision yourself. When someone pressures you to upgrade your house before protecting your income, you can simply say, "That does not fit my plan." When you feel tempted to skip coverage because the premium feels annoying, you can say, "Run the numbers first." When a salesperson pushes a policy with features you do not need, you can calmly say, "The math does not support that." When you feel rushed into a decision, you can say, "I can wait," and you can mean it without any guilt. When friends question why you spend money on something invisible, you can say, My priority is cash flow protection. These phrases are not slogans. They are tools that protect your decisions from social pressure and emotional impulse buying. They are also the kind of phrases that quietly mark the difference between someone reactive and someone financially mature. Now let us go deeper into the nuance, because disability insurance is not a one-size-fits-all decision for every person. Not every policy is worth buying. Not every rider is worth the extra cost. Not every agent gives unbiased advice. The definition of disability matters enormously. Own occupation coverage is far stronger than any occupation coverage in real claims. Own occupation means you are considered disabled if you cannot perform your specific job, even if you could do other work. Any occupation means you are only covered if you cannot perform almost any job at all in the broader economy. That difference can be the difference between a policy that pays out and a policy that quietly denies your claim. The elimination period also matters. That is how long you wait before benefits begin after a disability is confirmed. A 90-day elimination period is common. A longer elimination period lowers premium but requires a stronger emergency fund as backup. The benefit period also matters. A policy that pays only 2 years is very different from one paying until age 65. For most primary earners, a benefit period to age 65 is the version that actually protects long-term financial stability. Cost of living adjustments matter too, because inflation will quietly erode a fixed benefit over a 10 or 15-year claim. A policy without inflation protection can lose enormous purchasing power exactly when you need it the most in real life. These details are not exciting, but they are the difference between real protection and paper protection that fails under pressure. This is the kind of decision where you slow down, ask careful questions, and refuse to be rushed into anything. Pause before buying. Wait 1 day. Look at the full annual cost. Review the contract language line by line carefully. Say less when an agent pressures you. Do not justify your financial boundaries to anyone trying to sell you something. Do not rush because someone else is creating urgency. Real protection is built calmly, not in a single hurried meeting. Now here is the part that almost no one talks about, but it might be the most important shift of all. Disability insurance changes how you think about your future self, and that change quietly improves every other financial decision. When you protect your income, you are essentially making a promise to your future self that you will be okay. You are saying, no matter what happens to my body, my plan is not going to collapse onto my family. That promise reduces a kind of background dread that most people do not even realize they have been carrying around. And when that dread fades, you become more generous, more patient, more strategic, and more present in your daily life. You stop making decisions from scarcity, and you start making decisions from a quieter, more confident sense of stability. You stop hoarding money out of fear, and you start allocating money out of intention and clear long-term purpose. You stop avoiding the numbers, because the numbers are no longer terrifying when the worst-case scenario is already covered. This is what financial maturity actually looks like, not high returns, not flashy net worth, not impressive job titles or houses. Real financial maturity is the quiet ability to make calm decisions because the foundation underneath you is genuinely solid. Disability insurance is one of the few financial moves that creates that foundation in a way almost nothing else does. Emergency funds protect you for months. Investments grow over decades. Disability insurance protects the entire engine that funds both. Without it, every other piece of your financial plan is sitting on a fragile assumption that nobody likes to examine. With it, every other piece of your financial plan finally has the structural support it actually needed all along. Now let me address one more common objection, because it comes up almost every time someone considers this kind of coverage. People often say, I would rather invest that premium in the market and earn returns instead of paying an insurance company. That sounds smart on the surface, but it ignores the timeline and the math of how disabilities actually unfold in life. If you become disabled at 38, you have not had decades for that invested premium money to compound into anything meaningful. You would need to already be wealthy enough to self-insure, and most people are not even close to that point yet. Self-insuring against disability requires roughly 10 to 15 times your annual income sitting in genuinely accessible liquid assets nearby. Until you reach that level, insurance is the bridge between your current reality and the financial independence you are still building. Once you reach financial independence, you can drop the policy. Until then, the policy is what makes the journey possible. This is why financially literate people often carry disability insurance for 15 or 20 years and then quietly let it lapse. It served its purpose during the vulnerable building years, and then they outgrew it, exactly the way the tool was designed. Now let me bring this all together because everything we have discussed connects to one deeper truth about money decisions. Money is not really about money. Money is about decisions, and decisions are shaped by the fears you carry into them. When you remove a major fear from your financial life, your decisions get sharper, calmer, and significantly more strategic over time. Disability insurance removes one of the largest, quietest, most underestimated fears that working adults carry around without naming it. Once that fear is handled, you stop making decisions from a place of survival, and you start making them from strength. You negotiate better, you invest better, you spend better, you sleep better, you think more clearly about long-term trade-offs. You stop confusing income with security because you finally understand that protected income is what real security is actually built on. You stop chasing the next raise as if it alone will fix everything, because you see the bigger structural picture clearly. You start building wealth the way wealth is actually built, which is slowly, steadily, and on top of a protected foundation. This is the shift that disability insurance creates, and it is why everything changes once you finally put it in place. Not because the policy is magical, but because the clarity it creates touches every single financial decision you make afterward. You become harder to mislead. You become harder to pressure. You become harder to rush. You become harder to scare. And in a financial world built on selling fear, becoming harder to scare is one of the most valuable skills you can develop. So if you have been postponing this decision because it feels uncomfortable, consider that the discomfort is the cost of avoidance. The decision itself is not nearly as heavy as the quiet weight of carrying unprotected income year after year after year. You do not need to figure it out today. You just need to stop pretending the risk does not apply to you. Look at your income. Look at your dependents. Look at your savings. Look at your debts. Look at your honest exposure. Then, ask yourself one simple question. If my income stopped tomorrow for 2 years, what would actually happen to my life? If the answer scares you, that is information. That is not weakness. That is your financial intuition telling you something important. Listen to it. Act on it. Protect the engine that funds everything else you are trying to build for your future. Because the real goal of money is not piles of cash. It is the freedom to make calm decisions under pressure. And that freedom begins the moment you stop pretending your income is invincible and start treating it like the asset it is. If this changed how you think about disability insurance, take a moment and reflect on one decision you have been postponing. Share your honest thoughts in the comments because someone reading them might quietly need exactly the perspective you are about to offer. If this kind of clear, calm, practical financial thinking helps you, consider subscribing so we can keep building this clarity together. Protect your income. Protect your decisions. Protect your future self. And remember, calm money beats loud money every single time.